Right now, as of April of 2023, our economy has been through some rough times. The economy has experienced rapid inflation as the world started recovering back from the pandemic. And in response to this, we have seen the Federal Reserve raise interest rates, and they still continue to do so with no sign of stopping. We've also seen the banking collapse of three major banks: Silicon Valley Bank, Signature Bank, and Silvergate Bank. Yet, as Warren Buffett says, be greedy when others are fearful. And I'm telling you guys to be greedy and not be fearful. I have found a stock that has been greatly undervalued in these recent times due to these aforementioned macroeconomic headwinds. So, what exactly am I referring to? I'm talking about a company behind some of the most popular software products that we use today. It's what allows us to read the news, read our emails, or guide us to our destinations, or even to be able to watch this video. Ladies and gentlemen, and esteemed judges, my name is Krish Kawle, and I present to you Alphabet Inc., ticker symbol as GOOGL on the NASDAQ. So here's the stock summary. Shares are currently being sold at around $103, and by buying Google, you can expect a 30% plus return in around 12 to 18 months, even if there has been a 25% decline due to the market downturns. So, company overview. Alphabet Inc. offers various products and platforms such as services, Google Cloud, and its most popular platform, Google Search, which occupies a 90% of the total market share in the search engine industry. And because of this, Alphabet is able to have a market cap of $1.3 trillion. And as of 2022, this company made $282 billion. So it's a lot of money here. So let's look a little bit at the comparative industries and analyze them. In interactive media and services, the industry has been declining by around 22% in the past 12 months, but it's expected to rebound by 15%. And again, that decline was due to the state of the economy right here. We can see that AI services are starting to pick up, with the expected value by 2025 to be $90 billion. As for short videos, we're seeing what was initially a $1 billion total market value in 2020, expected to grow to $2.3 billion market value by 2030 at an average forecast of a growth rate of 10% over this 10-year period. We're also seeing cloud services grow as well, with an expected forecast of 30% over the next 4 to 5 years. So let's look at how Alphabet is performing in these areas. It is the leader in space and owns 26% of the market share in digital advertisement markets. And it offers services such as mentioned before, Google Search or Chrome, Google Maps, or YouTube. Now, because their main product, Google Search, has a 93% market share and it's ubiquitous to searching up something, this enables Alphabet to collect large amounts of user data based on the keywords that users type into Google Search. And this allows Alphabet to put out more personalized ads and increase the rate of investment for their advertisers. This also allows Alphabet to have a wide economic moat and have a network effect to their various products applied to their various industries. Now, another one of Alphabet's products is Google Cloud, which, despite the slowdown in ad revenue for Alphabet, its Google Cloud business is growing by more than 30% year over year, and the business is still in the early stages of monetization. Once that is improved, this will serve as a strong revenue stream for Alphabet. But right now, Alphabet is benefited by customer loyalty and the high barriers to entry for new firms. Now, another one of their products, YouTube Shorts, it's grown as big as TikTok with the 1.5 billion logged in user base. And just like Google Cloud, YouTube Shorts is still in the early stages of monetization, but this will also serve as another strong revenue stream for Alphabet. Another thing is their competitor, TikTok, is facing severe scrutiny and a lot of bannings in many different countries. This will create a market gap that allows the opportunity for YouTube Shorts to fill that market gap. And it allows Alphabet to capitalize the network effect. Now, as for AI, Alphabet is creating a new AI chat service called Bard, and as they continue to do some R&D on Bard, Alphabet can significantly benefit from Bard as the overall AI market continues to grow. So let's look at competitive positioning. I have done the moat analysis and the Porter's 5-4 analysis. And what I've noticed is the main subsidiary, Google, has, as mentioned before, a 92% market share that enables that enables collection of a lot of user data and feed it to their growing business efficiency algorithms to produce more personalized ads and increase their ROI for Alphabet's advertisers. This also allows a wide moat due to the network effect. And because of this network effect and also these near monopoly status, because we're talking about a 90% market share here, because of the network effect, near monopoly status, they're able to handle, Alphabet is able to handle these five threats as shown here with the Porter's 5 force analysis. They're able to handle these five threats efficiently and effectively. So let's talk about financial overview. Although there has been a slowdown in growth, Alphabet is still in a strong financial position. Despite recent declines in some of its growth, things such as its gross profit or earnings per share, there's an expected rebound of this once the market stabilizes and adjusts to the interest rates and inflation and other stuff. Now let's talk about risks and mitigation. Three main risks here. First is cyclical advertising revenue exposure. Basically, a lot of the revenue that Alphabet makes runs on ad revenues, running ads. And currently that is decreasing right now because not many firms want to spend that much money in advertising when they're currently dealing with an inflation and a banking collapse and high interest rates. But once the market stabilizes and adjusts from these crises and recovers back to normal, we will see this revenue pick up again. The second risk is competition for shorter videos. Short video platforms such as TikTok blew up, and they have blown up recently because the younger generation wants to consume shorter content, which goes against the YouTube policy of running ads on longer videos for their users. As a result, Alphabet is expanding on YouTube to create YouTube Shorts, and so far they are successful. Finally, we have the iPhone dominating the Android OS in the USA. Although Alphabet has a 70% market share in producing phones globally, Apple has a 50% market share in the US with their iPhone. So, what can Alphabet do? Well, instead of trying to beat them, they can join them. And they're basically paying Apple $15 billion to have them use Google Search as the default search engine in Safari. So you can see that these are the three main risks of the company. We can obviously see Alphabet is doing a great job mitigating each of those risks. Next, let's talk about ESG considerations. Currently, Alphabet has $5.69 billion stored in sustainability bonds, and it's using it to fund environmental projects such as green buildings, clean energy, or energy efficiency, and social projects such as supporting small businesses or maintaining affordable housing. Alphabet also has motives in creating a diverse workforce, and it also has a human rights program and great transparency with its Google Transparency Report Hub. And in terms of governance, the company has also adapted a horizontal governance structure, and it continues to make sure that diversity and inclusion are a part of what they do. And based on all this, the ESG risk rating for this company is 24, which is of moderate risk, which is good. And also, Alphabet is taking the appropriate measures to mitigate their risks. Finally, let's talk about energy transition efforts. So, due to the high inflation in the current state of the economy, energy costs are extremely high and they're continuing to rise. So, as a result, Alphabet is working on looking for alternative solutions, especially with renewable energy, specifically wind and solar energy, and they're investing technology in this as a long-term strategic investment. And overall, in the short term, Alphabet is working on restructuring and cost cutting to maintain their bottom line. But overall, the company's goal is to operate on carbon-free energy, and they're working towards that goal when in 2021, its subsidiary Google stated that approximately 66% of the energy that these data centers consumed was carbon-free energy, which is a great step in the right direction. Alphabet is also using AI tools like DeepMind to cool data centers, or Project Greenlight to use it as a way to measure driving trends and make recommendations to reduce fuel consumption and air pollution. Now, these are just some of the many energy initiatives that Alphabet is taking. And if you want to learn more about this, you can check out these links right below, down here below. It's an interesting read. It gives you a better idea of what this company, Alphabet, is doing for the environment. Now, here comes the big part of the presentation, which is the projections and the evaluation of this stock. Basically, I've used the EBITDA multiple valuation method, and I've used the analyst provided EBITDA growth forward rate of 7.52% based on what's been providing in seekingalpha.com. And I've used it to calculate these values here and get an upside percentage. Then I took this upside percentage to get an idea of the target stock price. And what this shows me is if we have a base case where the market does not happen to be in a bull run or a bear run, there will be an expected 33.52% growth rate in this stock over the next 5 years. Now, if this market were to experience a bull run in the next 12 months and overall in the next 5 years, then there will be a 54 or even a 55% increase in the stock value. And if, worst case scenario, this economy is going through a bear market over the next couple of years, this stock will still grow by a positive growth rate of around 16.8% over the next 5 years. So overall, the way I see this, it's a winning stock. And the final verdict is you should buy Alphabet to hold because of its strong company financials, its global market shares, the network effect, customer loyalty, its energy initiatives, and as we've seen before, the stock valuations. This makes it the perfect stock to buy to hold, as this stock will continue to increase value for the next couple of years. Thank you for listening to this presentation. My name is Krish Kawle. If you have any additional questions about any information stated here, you can check out my email right here below at krishkawle2017@gmail.com. Thank you and have a great day.